Okay, now you've all been waiting for Leslie Appleton Young, so I'm going to bring Leslie Appleton Young out here. She's been here before. She's a friend of Intero. She needs zero introduction. She is the best economist in the country. So let's give a warm Intero welcome to Leslie Appleton Young.
You know, I'm back there, and that was so inspiring. I won't tell you how old I was in 1963, because it's trying to be upbeat today. But anyway, it was, we need more energy in the room. I'm thinking, oh, that's great, they need more energy, and they're going to bring on the economist. So I really do my best. And thank you for having me back. I'm delighted to make a biannual appearance in front of all of you and kind of share the market stats and a little bit of analysis of what's going on, and it's really, really crazy out there. I haven't gotten my Market Watch email yet on what the market's doing so far. I hope it continues to do what it did yesterday, but it really has been absolutely insane. So let's kind of step back a little bit, take a deep breath, and lo and behold, the housing market was cyclical before derivatives. It's hard to believe, but this slide goes back to 1970, and it shows you the ebbs and flows in the market, and also the ebbs and flows in the number of realtors in California. There's about a 2-year lag between a peak in the market and a peak in membership. The market peaked in 2004 and 2005, statewide, at about 625,000 transactions in each of those 2 years. In 2007, the membership in the California Association of Realtors peaked at 211,000, and we are budgeting 09 for 158,000. And my guess is 2010 and 2011 will see further contraction. So we've had a lot of people come into the market in 02, 03, 04. Some of them have staying power and are doing really well, but we're having a bit of a shakeout, which I think is not a bad thing. As you look back to 1970, again, in terms of the degree of downturn, we had about a 61% sales decline, peak to trough in the late 70s, about a 25% in the late 80s, early 90s, and this time around it's about 44% peak to trough, with the bottom of the market in terms of transactions actually being reached last year. So getting kind of closer in here, this is monthly data going back to 2000. And let's start with the really good news. If you look at the last 5 or 6 months, the pace of sales has been like a good, strong, normal market. We've had 489, 490, and 502 the last 3 months in terms of the annual pace of statewide sales. Now, a lot of that activity is taking place in distressed markets, foreclosures, REO, whatever, but those properties are moving, and that's really, really good news. Secondly, you can see if you look at September of 2007, that was the bottom of the market. The annual pace of sales was 265,000. So you can see how far we've come, and then finally, the peak of the market was mid-2005 with about 650,000 transactions at an annual pace. October, November, and December of 2005 was the very first quarter where every month we saw sales below your earlier levels. So what that means is we are in October celebrating the 3rd anniversary of the down cycle of this cycle, so to speak. So it didn't just start a year ago. We've actually been through quite a bit. This slide I just wanted to show you. If you look at the black line, that's transactions so far in 2008, and compares it with 2007 and 2006. So we have surpassed now over the last 3 months the prior 2 years. So that's kind of digging our way out in terms of transactions. The median price data has been very, very misleading. The market dropped about let me see if I can get these numbers straight, about 23% in 2005 and about 26% in about 23% in 2006, about 26% in 2007, and yet if you eyeball the median price in California, it looks pretty darn strong. And actually it wasn't until September of 2007 that we started to see the statewide median go down. And it's really very simple to explain. Even when you're using a median, if you get a huge change in the composition of what's selling, it's going to impact the overall number. So the overall number of sales went down, but the moderate and low end went down a whole lot, and the high end was doing pretty well. So that created a situation where you didn't see the median price. And again, look at that black line, that's the median in 2007. You really didn't start to see that, that median impacted until the third quarter of 2007. Another way of looking at it is August 06 to August 07, the million or more market in California was only down 3.4%. 1 month later, that market was down 26.4%. Why? Well, we all know why. Jumbo financing dried up. That's when the credit crisis and the credit crunch really took a bite out of the real estate market. Last summer, about 40% of the properties being sold were 500,000 and below. Today, it's upwards of 72%. So that's the response in the market we've seen to the dramatic decline in prices in areas that are really dominated by distressed sales. What happened with rates is really critical in terms of understanding how we got to where we were and where we are right now. And I just wanted to kind of show you this slide just to say I really am feeling a little sorry for Alan Greenspan right now. Because hindsight's 20/20. And when you look at the decline in the funds rate that the Fed initiated in 01, 02, 03, and through 04, it's really pretty dramatic. I mean, it was, let's get the liquidity pumping in this economy so the tech stock downturn doesn't seep into the rest of the economy. And of course, what happened, I'll say more about this in my remarks a little bit, what happened is it created an unprecedented supply of credit for the housing market. It also created a situation where the trade deficit and the federal government deficit, there's this huge giant pool of capital being held overseas that's looking for returns, and they're obviously not going to get it in T-bills, right? Because the rates are so low. They're looking for higher rates of return, and they found that in derivatives stemming from mortgage-backed securities. So this is it's a really, really interesting story. But back to the market, in terms of the growth that we're seeing, it's first-time buyers, investors have really shown the most dramatic increase if we compare today compared to a year ago. First-time buyers, if they're qualified, FHA, whoever thought that FHA would be big? It's now like 20% of the market in California, like who knew? So that's been pretty interesting. The inventory, as we measure it, which is data that we get from the multiple listing services, so it's listings over sales. So what 6.5 says, at the current rate property is selling, you have about a year's worth of inventory. So this does not include the properties that aren't in the MLS, that are being held back by banks, who are kind of waiting to see what the loan mod directives coming out of Washington look like. So in reality, it may be a little bit more than this, but it is a reflection of the increase in sales that we've got what I would consider to be a more reasonable inventory. And here you can just see where we are in 08 compared to 07. So that tightening has been a good sign. On the new housing front, there are certain areas in California, obviously right here in Silicon Valley, not so much, but as you get further and further away from the Bay, you had a lot of new construction competing with existing single-family homes. Well, that's not going to be too much of an issue in terms of the addition to that stock over the next couple of years. The builders have been obviously hit very, very hard. Year to date, we're down over 45% in terms of permits in the state. Okay, I'm going to talk about the Bay Area and Santa Clara with the following caveat. Be aware if you work out